Good morning, everybody. Happy Wednesday. And as usual, we're doing our Instagram Live here on my Instagram page. And we're waiting for our partner, David Gazarian from the IQ Great Mortgages, to join us. The topic of today's live is still do not make certain mistakes. And as David is joining us last week, turn your camera, please.
It happened again. Good morning.
Can you hear me okay?
I can hear you fine. How are you, Alexandra?
Doing great. How are you?
I'm okay. Hello?
Did we just disconnect? Yes. Sorry.
Yes.
Sorry for that. So I just wanted to continue the topic that we started last week. And I think this is a pretty important topic for everybody who is joining us, who is watching the videos later. It's the topic of what not to do. And last week we were discussing what not to do with the credit.
Yep.
And this week, I would like you to add on if there's anything else with the credit and continue to the other two aspects as the income and assets. So let's jump right in.
Sure. So let's start with the credit. The most important thing, again, is not to add any more debt. Debt is detrimental in calculating your debt-to-income ratio. The more you owe, the less is allocated to the mortgage, and your mortgage becomes smaller. So a lot of times, if somebody doesn't qualify for the amount of mortgage that they want, Alexandra, we tell them, let's pay off this credit card, maybe pay off this car. So we have less debt, and this payment will be allocated to the mortgage payment. So that's the amount of debt is important. Hello? Can you see me?
Yes, I can see you.
Okay, good.
So could you tell us, though, for conventional mortgages, it's like the most amount of debt that the person can afford at any one time is what, 43%?
43%
income.
Sometimes if the guideline says if you're above 700 FICO score, if you have a decent down payment, if the electronic underwriting system seems comfortable with you, it will let you go up to 49.99%. Sometimes that's a secret. We rely on it. Sometimes that's up to the system to issue an approval at 49% DTI. If we have
but it's more of an exception than the rule, correct?
It's quite common, to be honest with you. If someone has 720, 740 FICO score, they have a decent down payment, then yes, that's quite common. We can count on that. We don't promise it, but we can obtain it easily.
For the FHA loans, what is our debt to income ratio that people can calculate?
FHA has two debt to income ratios, but again, I know we're trying to be helpful, Alexandra. I don't suggest people try to calculate their debt to income ratio. It's not as simple because they do always seem to plug in numbers that we don't count or forget numbers that they should count. So it's not quite accurate, but I'll tell you, it's 46.99% for the front end meaning your owner occupied, FHA is an owner occupied loan. So the loan itself, the mortgage itself is 46.99, and the back end meaning 56.99, that's everything combined, including the front end, the home, plus everything else you have. So there's a leeway of 10% for your cars, credit cards, everything else. One very, very important factor with FHA, Alexandra, is if you're married, if you have a spouse legally on paper, and if the spouse is not a co-borrower with you, you decide to apply for the mortgage by yourself. With FHA and VA loans, we have to pull the spouse's credit, and the spouse's monthly payments will have to be added to your DTI, which is why FHA is a bit more forgiving. It's at 56.99% because we have to account for your spouse's DTI as well, liabilities as well.
and the reason why you're not advising people to try calculating their own debt to income ratio is that a lot of times people forget about certain things and they have no idea that they will be calculated, such as if you are making payments to the IRS. Or if your loan, let's say right now you're in the loan forgiveness program, but the payments are going to kick in within a certain period of time. Is that correct?
Almost, yes, absolutely. Thank you for that. So almost always when a client calculates their DTI, they will pull their credit, which is readily available, Credit Karma, for example. And if you see a student loan at zero payments, like David sees zero payment, I didn't calculate it. Well, guess what? If you have a balance, even if it's deferred, and just about everyone was deferred, and after COVID, if it's deferred, we're going to have to calculate some percentage. Now, depending on what we do, if we're doing FHA, that's 0.5% of your overall balance. If we're doing conventional, it could be 1% of your overall balance. So if you have $100,000 in student loans and I'm doing a conventional loan for you, I have to hit you with a $1,000 payment to your DTI. Does that make sense? So
even if you're not making the payments right this
correct.
moment.
Even if your report shows zero, we still have to allocate some payment to. So that would be a zero. 1% in case of conventional, 0.5% in case of FHA. Now, a lot of times people calculate their utilities in a DTI, which you're not supposed to, which is why we're not taking 100% of your income. We're only taking 45%. We understand you have car insurance, you have groceries and other expenses. That's why we're not taking your full budget, but only half of it. So those things are not showing on your credit report. You don't have to show them. But if you have alimony, if you have child support, those things do get added to your debt to income ratio. And you're absolutely correct. The IRS balance gets added to the DTI calculations as well.
Yeah. So for everybody who is listening and watching us after the live, it is important that the professional does the full calculation. And once again, it is important that the loan officer that you're talking to actually pulls your credit properly before calculating this this ratio, because at the end of the day, if you're trying to save yourself from the credit pool and you know, like you don't want the loan officer to see your credit, you're not doing yourself a good favor, just because at the end of the day, when you get to really pull the credit, some unforgiving facts can come up, and your pre-approval or your pre-qualification letter can be wrong, correct? Can be,
that's correct.
Like, be misstated as far as the purchase price, possible purchase price.
Yeah. It always is going to boil down to find yourself your local friendly neighborhood loan officer, build a relationship with them, and speak with them as early as possible. Not when you're ready to buy a house. Speak with them earlier. Get that sense that you're qualified. Chances are he'll probably give you some pointers, a to-do list of things to work on. So it's always good to talk to a loan officer. We're not allowed to charge you for a consultation. I wish we were, but we're not. So go use that opportunity and find out what you could qualify for. Absolutely.
Well, I can tell you that very recently we had an offer submitted on one of our properties, and I will not name the website, but it was something like lendingormortgage.com. So it did not have, it did not have the loan officer name. It definitely came from the website. And I had a conversation with the buyer's agent representing the buyer.
So you were the listing agent. You were selling the house. Okay.
Yes, I'm the listing agent on the house. So I have the conversation with the buyer's agent, and I asked them, did you take your client to a local trusted loan officer? And the agent said, no, we already have a pre-approval letter.
You're a clown.
Did you actually? Yeah, and I asked them if they actually had a conversation with the the person from that website. I'm like, do you realize the difference between the real pre-approval letter and the one that you are submitting with your client? And the agent got a little bit offended, to be honest with you. And they were like, oh,
Alexandra.
We know how to do our job. And I told the agent, I'm not telling you how to do your job, but I will absolutely advise the seller accordingly that this is not the approval letter. And I told him if we go into the negotiations on this offer, one of the conditions is going to be inevitably that you get the pre-approval from the local lender of your choice. We don't care who the lender is, but like as long as it is a local lender. And for the person who is asking us to add for the video, if you have a question related to the real estate or the mortgage market in the state of Nevada, you're more than welcome to post it. We will be happy to respond to it, but sorry, we will not be adding anybody to the video. This is not the purpose of this live.
So what I would do is, in a situation, I would definitely reach out to the loan to that lender, whoever that is, .com lender, and speak with the loan officer and confirm that loan officer client is approved. 99% of the time, the loan officer is going to be they used our electronic system. We don't know who they are. We haven't done the work. We haven't calculated anything or verified anything. So, and I would take that as an answer. And whoever gets offended so easily should have an educational moment if you've got the time to spare and educate them on.
Well,
so, but by all means,
the buyer did go to the local lender, and it turned out that they were qualified. They were qualified, but the qualification was for $80,000 less than the letter that they submitted to us, which resulted in them not qualifying for the purchase price and for the house that we were, that they were applying for. So
it is what it is.
And that is the truth. It could be my client's time spent. We could have taken the time off the market. We could have stopped marketing the property if we did not request the proper qualification. And the same thing to that agent, that they would be wasting their and client's time. So there is nothing, and for everybody who is listening to us, I would say one more thing, that there is nothing offensive. It is actually proper process when you know exactly how much you qualify for, and that is respecting your time, respecting your agent's time, and respecting the seller's time as well. So, go through the process properly. Don't do it halfway, and this way you will avoid the frustration to begin with.
Do's and don'ts, income assets.
Yes, please. So talk to us about the incomes. What don't we do? What are the big don'ts of the income if we're getting ready to qualify for a mortgage, or if we are already within the process of the mortgage application?
Do not quit your job. Just do not quit your job. If, as a loan officer, we have qualified and calculated your income, your last 2 years of employment history, we have verified, don't quit that job. You see, the bank is loaning you money for the next 30 years. They don't know what's going to happen in the next 30 years, how much money you're going to make. So the only thing they do have is what you've made in the last 2 years. So they want to see last 2 years of history of income as some sort of something to rely on to extend credit for the next 30 years. Okay, so be as consistent as possible. You may, however, get a raise in the same company, within the same company. Don't change the type of job. If you're this happens so often within the company. So, for example, we just had a client. He makes quite a bit. He makes decent money. He makes $300,000. Some software engineer, and he went from W-2 to 1099. Calls me up from California, David, I'm ready to buy a house. I'm like, no, you're not. You'll come back in 2 years because you just switched to 1099, which means you just became self-employed. You need to stay self-employed for 2 years. You shouldn't have done that. You should have asked me. So he's going to go back to W-2. I guess the boss doesn't care. They're like, we'll pay you anything, whatever you want.
And that's the question, David, that I have for you as the professional, because we had those situations before, and the way how you were able to solve it is for exactly what she said. If you happen to switch from the W-2 to 1099 within the process of your mortgage application, and you have an option to go back to W-9, let's say you only got paid once through the, once in 2 weeks, like you only have one paycheck for 1099. Can you switch back really quick and turn the time back and turn the time around and still qualify?
Unfortunately, one of our loan officers just had a loan decline because of that reason. You can't go. Things have to make sense. This is called common sense underwriting. You can't just be 1099, flip it over to W-2. Now I'm W-2. And out of all, in this situation, the husband's the employer. So it has to make sense. And it has to be verifiable.
If you were W-2, you didn't talk to your loan officer, you decided to switch to 1099, and then your loan officer says, no, you can't do that, it's going to set you back by 2 years. If you switch back to the W-2 with your employer, you're good?
Fine. You're fine, of course. Yes, you are. You do have the history. You do have the history. Some small companies, big ones too. Google does this to a lot of their independent contractors. Google employs an army of software engineers that are not per se Google employees. So this is actually a thing in a software world, in the IT world, where they will. So they don't have to pay you for the payroll taxes, FICA taxes. They will have you open up an LLC, pay you as an independent contractor. But if you so wish, they can put you on payroll.
David, another question to you, which also is a very common situation. So let's say if a person loses a job or gets laid off during their loan application process, and finds another job, what are the criteria? Talk to me about that. This is a very common situation these days. You know that a lot of companies are going through the layoffs.
Unfortunately, yes. So on the day of funding, the funder will call the employer and do what's called a verbal verification of employment. They call them. They don't ask about how much. All the details have been verified. So they're not calling to verify the details of your employment, but they're just calling for a simple fact to see if you are still employed there. And I've had situations where the person had lost the job involuntarily and the loan falls apart, which means you don't have a job on the day of funding. The funding doesn't happen. Yes, your questions, if you find another job, well, Fannie Mae's guidelines say you could close a mortgage with 30 days of pay stubs, which means now it has to get extended for a normal, traditional, conventional loan. We got it extended for 30 days to give you a chance to make 30 days of pay stubs. In this situation, there is, I don't want to complicate things, but there is a future income loan program with Freddie Mac, where if you are a certain pay structure with a proper employment job offer letter, we will be able to close your loan.
So it is a very unique individual situation that should be looked carefully upon by the loan officer. So, David, another question would be for the relocation people, the ones who've been working in one office in one state, and they're relocating maybe to the same position, might be to a different position. And I know that the answer is going to vary based on whether they're getting the same position or a different type of a position. So could you please comment on that?
Yes, that's actually quite simple. Relocation loans are quite simple because they're relocating very often within the same company. So there really is no difference. We could just get a letter from the HR department that, yes, this Joe and so is moving to our sister company in the state. That's all we need, really. So we could use the old pay stubs, everything. To us, nothing's changing. If they're relocating to a new company to take on a new position, then we just do the 30-day pay stubs still matter. So we're going to get pay stubs. The job offer letter plays a crucial role in verification, and we will work with the HR department to verify that this person is in fact getting a job. Interestingly enough, we had a situation where the employer called us. We were trying to verify a new employment, and the employer called us. He said, "What do you mean he's moving to Las Vegas? I gave him a job to move to Utah." So all sorts of things happen.
I remember that one.
Oh, yeah, okay. Never mind then. But all sorts of things get uncovered when you, it gets really interesting.
Yes, and as many, as many people, as many situation, but for those watching us, if you guys are relocating to a new place of work in a new state, you need to remember, if you're a buyer or if you're representing that buyer, you need to remember that the lender will most likely require 30 days of pay stubs. So make sure that your close of escrow date actually reflects that and reflects this amount of time, so you don't put yourself into a pickle, because none of us likes to change the terms of the contract. So you can be a little bit more foreseeing and a little bit more careful with those. So that what comes through the income. Now, David, if I lost the job and I filed for unemployment, what happens to me then? Let's say I lost the job, I stayed on unemployment for, I don't know, 6 months, what the unemployment can be, and then I found another job. How does the situation unveil in this case?
Unemployment is just a type of income. Unfortunately, the problem with unemployment is it's a temporary income. So when I just described in the beginning of our conversation that we look at the last 2 years to sort of be able to predict what's going to happen with you for the next 30 years, okay? So unemployment is one of the sources of income you may qualify for, but Fannie Mae's guidelines and Freddie Mac clearly state that any sort of income that you get, we need to be able to verify that you're going to get it for the next 3 years. 3 is the magic number. For example, let's kind of step away from unemployment. Let's say you have child support income. Or any other type of income, we need to verify it's going to happen for 3 years. Now, if you're working somewhere, we're assuming you're going to work there for 3 years, so there's no way for us to verify, so that number never really comes up. But let's say you have child support. We're going to get the child's birth certificate, make sure that this child doesn't turn 18 within the next 3 years. If she does, then you don't qualify. We don't get to use that income. Same with unemployment. You would be able to use unemployment if we were able to verify that you will be getting unemployment for the next 3 years. I've never had that happen. In theory, it's possible. So, in theory, it's possible, yes.
But here's the question. So let's say if I come to you and I'm currently on unemployment, is that a good time to apply for a mortgage, or should I get a job first and then come to you and say, David, I was working at this job, then I had 6 months unemployment, and now I've been on this new job for a few months?
To stay consistent with my advice is, even if you're on unemployment, still come talk to me. If you have the resolve, the decision, the intention of buying a house, go talk to a loan officer. Now, you may kind of guess that you're not going to get a house with unemployment unless you can prove that you're going to get the unemployment for 3 years and we're able to verify with the state, you're not going to get a mortgage. But I may give you different pointers, things to focus on. Maybe low debt, maybe improve your credit score. Quite often people have collections they don't know about. So I'll tell you, go get rid of the collection, delete that. So there's other aspects of qualification that you and I can work on while you're looking for a job. So still come talk to me. So again, consistent with our theme, talk to a loan officer as early as you can and get as much information as you can. So work on things. And the loan officer is going to tell you that finding a job is going to be one of the crucial aspects of qualifying for a mortgage. So once you get your first pay stub, come back. We'll look at it again.
So would it be correct to say that the fact that you were on unemployment for a period, like within the last 2 years, does not disqualify you from getting a mortgage? Like, well, being on unemployment does not mean that you will not be able to get a mortgage.
Your questions are getting more and more, how do I say that, deeper into mortgage world and guidelines. So I love it. So Fannie requires that we verify your last 2 years of employment. If in the immediate last 2 years of employment you haven't held a job, we're going to ask you, when was the last time you held a job? Maybe prior to 2 years ago. Mm-hmm. Okay. Let's get that. Well, we're going to have to verify 2 years of employment. Even if it was 10 years ago, we're going to have to verify 2 years of employment. So, yeah, and unemployment goes on there. We show on your taxes, we get your 1099s and all that because that's taxable. That gets verified. And then you find the job and that gets verified.
So another situation that I had with my client says she was a waitress for a very long time. Mm-hmm. And then she switched to, like, she was a waitress on W-2 plus tips. Mm-hmm. And then she switched the jobs. She went to work for one of her relatives as the manager in their company. Mm-hmm. And obviously her salary went up. But mm-hmm. After 3 months on that job, she came over and she said, now I'm making better money. Can I get a house? What happens in this situation?
That's fine. If that relative is not a family member, immediate family member, then you're fine to get that job. And we're, again, going to verify there's so many things that go into underwriting scenario.
But that job has nothing to do with the restaurant business.
If you changed industries, there's a different guideline. You have to stay in the new industry for 6 months. Okay, so that person would have to stay within this industry for 6 months. If in the prior industry you were making an X, now you're making 3X or 4X. If your pay has gone up several 100%, let's say you're making $1,000 as a waitress, now you're making $8,000 as a software developer. It's going to have to make sense. You have to somehow verify it because it looks phony. Your diploma, your certifications, all of those, you're going to have to substantiate why you had such a big jump in career. And frankly, someone within our company had a loan decline for that very reason this morning. So we were discussing it because you have to understand it doesn't look natural when you have an 8X jump in income. You better substantiate. You need a stronger file.
So once again, if you're looking to increase your income through the job change, before you do so, go ahead and talk to the loan officer. Now, another case that I would like for you to tell us. So, have a client, he has a job, but obviously to make a little bit more money, he started doing an Uber and Lyft in his free time. And now he's making an extra $1,500 per month, plus his main job. But he only started doing it in April this year. can he use that income?
No. Any source of income you use to get a mortgage, you would have to have had it for 2 years at least. All right. So we verify one source, whatever that is, 2 years. This new one, she has had since April. That gives us 6 months. You're going to have to wait another 18 months. So that'll be April of 2025. That's when that person will be able to use both jobs.
But that money, however, that money that he makes could be used towards the down payment if he qualifies with his main job income, correct?
Absolutely. Of course. It's income, yes.
That is something, that is something important. Now, talk to me about the part, how does the loan officer and how is the income treated if you're working, let's say, 2 part-time jobs or 3 part-time jobs? Does that affect the loan application as long as we're staying on those 2 or 3 part-time jobs for 2 years or no?
Same exact answer. Every source of income you have on your application that we're using to qualify for your DTI, you would have to have had it for 2 years. I've had clients that had 3 part-time jobs, and I've had it for, there's clients that have 4 part-time jobs. Those that we can substantiate they've had for 2 years, we could use those. Those that they haven't don't get to get used. But let's say, and this is going to complicate things. Let's say you had a part-time job, you quit, you found another part-time job that pays better. I could use the one, let's say you have 4 part-time jobs, but I can only use 2 out of the 4. The other 2 you haven't had for 2 years. I will be able to use the one that pays you the most today. Does that make sense? I get to pick that, yes.
So that's a good thing. Now talk to me about the seasonal workers. So we have a client of ours, and she is a massage therapist. And every time there is a World Series of Poker that is happening in Las Vegas once a year, she comes out from Reno, and she does this job for a different company, not the company that she works for.
She gets contracted, yeah.
Yeah, she gets contracted out just for the whatever it is, 4-6 weeks out of the year. She gets a good income. It's almost like it's almost 1/3 of her yearly income that she's going to make here, and then she goes back to Reno. How does this happen, and how do you treat the seasonal jobs?
Very simple. We got to verify that she's had it for at least 2 years on her taxes. So we need to show consistency. Seasonal employment's okay, but we have to show that you have been doing it for the past 2 years at least. Perfect.
So if the person makes like one big sale a year, let's say the person flips homes, and once a year they make $100,000 on a flipped home, or let's say they flip 2 homes a year, and that is what their income, but it's literally they get the 2 paychecks per year. Does it matter?
Yes, so I'm going to put my tax person hat on first. When you flip homes, you have capital gains. So let's understand the nature of income. This flipping homes is you buy something, you make changes to it, you improve it, and the value of your asset goes up, just like a value of a stock would go up. Okay, so this is not active earned income. You just had capital gain income. Capital gain income is very common, but again, we have to show 2 years of consistency. Now, going back to talk to your loan officer, because your loan officer may have to be very actively involved with your CPA to be able to do taxes properly. So you do qualify, okay? In these cases, if flipping homes is your full-time job, you may not show it on Schedule D of taxes, which is your capital gains. However, on Schedule D, you save on taxes. You may elect to show it on Schedule C, which is active employment. Now you're electing to treat this income as active employment because that's what you do. If you do that, you're going to have to pay FICA taxes. So that's just my past life as a tax person. That's very, very intricate conversations you need to have with your CPA to make sure that you do want to become a self-employed person, and that income, have it treated as active income versus passive income, capital gains. Active income is easier to prove on Schedule C. Capital gains is more complicated, but you could do both with 2 years of history, consistent history.
Excellent. So the short answer for those who are not as savvy in tax laws as you are.
Talk to your neighborhood loan officer.
Talk to your loan officer who actually understands what is going on your taxes as well. And guys, remember one more thing. Like right now, we're still by the end of the personal tax season. I believe October 15th, 16th, that's the due date. But it is very important that your loan officer and that your tax person are on the same page. And probably if your tax person does not want to come on board and talk to your loan officer and answer their questions, you might consider using a different tax service. And the reason I'm saying it is that not once we had clients whose CPAs, who tax preparers would not agree to cooperate with the loan officers and would cost our clients a lot of losses, such as they would cost the opportunity loss when the property would not be purchased. And it is normal from the loan officer to request certain letters from your CPA, from your tax preparer, and ask to explain certain items on your tax returns. And it could come from the loan officer, the request could come from the underwriter, but it is not picking on anybody in particular. It is a normal request, and just be ready for it, get prepared for it, and whenever you have your tax appointment scheduled, make sure that you mention it to your tax person that I might be going for a loan this year. Would you be willing, like, what do I need to do if my loan officer needs to talk to you or needs to retrieve any information, any explanation from you? You need to know that your tax person is on board, that they will respond to those requests, and most likely those requests would be to respond in writing on the official letterhead. Am I saying am I saying it right? Is there anything else you would add to it, David?
All these lives that you and I have had can be boiled down to two things. One is number one and the most important is build important relationships in your life with important people that you trust. And I've seen this happen with wealthy people consistently, those that have 10, 15, 20 rental homes. They have a CPA that they trust, they know for a decade or more. Okay, so the professions that matter, a real estate agent, the property manager, the attorney, the insurance agent, the CPA being one of the more important, build these relationships. And the next thing is going to be talk to your loan officer as early as possible. Now, what you're referring to, yes, CPAs, specifically CPAs, have an issue with issuing certain letters because they say that their errors and omissions doesn't allow them to do it. But, at the end of the day, they're going to succumb and they're going to issue that letter. So they're just playing hard to get, but it does, we're going to close a loan. Yeah.
And I mean, in the worst case scenario, you can go and submit your taxes to a different CPA and get a letter from a different CPA if it needs to be, as long as that CPA is licensed. And
if you've had the relationship with the CPA, they're not going to give you a hard time. They're going to trust you. They know your situation. They have been preparing your taxes for many years. They know your financial picture, and they're going to feel comfortable issuing that letter. So it's not a big deal.
Thank you. So what else do we have on the subjects of income? Are there any situations? I think I listed all of the situations that our clients were worried about. Maybe a little bit on a passive income, if it could be used, and maybe a little bit on the talk to us about investment properties. If I'm buying an investment property, can I use the potential income that I am going to get from rent?
You must. You have to. Well, not that you must, but rental income is passive income, which means it's the sort of income that you don't work for actively. Yes? So rental income is very, very useful because it's cheap income versus self-employment where you have to pay FICA taxes, Social Security, Medicare. On passive income, aka rental income, you don't. So I've had clients, Alexandra, over the years that only qualified based on rent income. I have clients that only have rental income. They have many homes, and that's their main source of income. Again, we're going to have to work with the CPA, make sure that taxes are filed properly. But at the end of the day, rental income is one of my favorite incomes to qualify for a mortgage because it's so affordable.
David, if I want to get an investment property, and I'm not going to occupy it. I know it's a totally different animal, so I am looking to get a rental home, not in, like, let's say I live in California and I'm looking to get a rental home in Las Vegas.
Right.
What the potential income from that house, and my sole purpose of that property is investment.
Can I use the future income?
Yes.
Absolutely.
Can I count on the future income? Because the number one purpose for me obtaining that property is rental income.
Let me say it depends. So with Fannie, Freddie, they slightly differ in their treatment of rental income. If you are a first-time home buyer, you've never owned a home before, they may not allow you to use that rental income because there stands the question of reverse occupancy fraud. So you may be, if you don't have enough income, you may be buying this house to live in, and you're saying that you're going to be renting it out so you can use the income. So that's the reverse occupancy fraud that banks are afraid of because they don't want to get in trouble with Fannie and Freddie. So that's the, I guess, the important issue. But if you own a house in California, then you're fine. We'll be able to use the income. If you own a rental, then you're fine. We'll be able to use the income. So again, it depends. The fact that you live in a different state and you work in a different state, you're buying here helps as well because you're not going to be living in this house. Your job is there. Does that make sense? So that helps as well. So again, it depends. Work has to be done. A solid application has to be built, and we have to make our case against the underwriter.
So would you say that there's no bad income, like we should actually, like, no, it doesn't sound right, no bad income. I would say, would you say that if people did not fit into a box, like I had the same job for the last 2 years and I'm at the same job on a W-2, it doesn't mean that you're not going to qualify. There are things that you should know, and there are things that the loan officer should look into, and sometimes you might be surprised that you are still qualified for a mortgage, even if you changed the jobs, even if you were on unemployment for a short period of time, or even if you were in the college. And that's another thing that I wanted to ask you. So let's say I just graduated from college and started on my job. Can you do something with that? I just graduated. I started on my job 6 months ago.
It depends. In some cases, with FHA loans specifically, we will be able to use the high school diploma or the college diploma in lieu of job history. This is a case for FHA, not conventional loans. Conventional loans are more stricter, but there is a specific whole category of loans, which is called physicians loans or doctor's loans. These are specifically for physicians, where they can look at your education history as employment history. So they're specifically for doctors because they make so much more money than us mortals. But usually it's not going to be across the board where your diploma counts as job employment. No. Job history, no.
Once again, check with your loan officer.
Check with your friendly neighborhood loan officer, yes.
Excellent. Thank you, David. Is there anything else that we forgot to mention on the income scale that our listeners and our future viewers need to know?
Not really. No, you're covering so much, and I'm sorry for my maybe complicated or long answers. I hope to benefit those few that are really intricate with their qualifications. They want to understand. They're those that want to plan. So those answers are for those people.
Well,
but no, you've covered it all.
Guys, sorry, David. I would say that the reason why David and I are here, we're not trying to solve every single problem here on those lives. What we are aiming to do is actually to give you the thought and to give you the grounds for the thoughts that there are so many different scenarios, and that every single person is going to have their unique situation, unique scenarios, and there's so many parts to the loan process and to the process of qualification, and the fact that your neighbors or your friends' situation was similar to yours and they didn't qualify does not disqualify you. And this is very important to know. Or the fact that your cousin has a worse situation or less of an income than you do, but they were able to qualify does not automatically mean that if your income is better, that you're going to qualify. It is very unique. It is worth visiting the loan officer, actually going for this free consultation and actually looking into your profile. If obviously we don't expect you to watch every single of our lives or the recordings, but it is way easier to pick up your phone, to work with David and his team, and to actually get your free consultation, get your questions answered. And if you're not ready today, you will at a minimum get a roadmap of what needs to be done, what kind of next steps you need to take for how long in order to be qualified, because we all know that the markets do turn around, and we know that the interest rates are going to go down. We're not going to sit here and predict when it happens, but we know it's going to happen. It's going to happen in my lifetime. It's going to happen in your guys' lifetime. So it's going to happen, and you need to make sure that if you're on the front end and your file is ready, your application is ready, then you might be the lucky one who gets to jump in the first cart of that train. Because if you don't, the moment the interest rates are going to start dropping, you know exactly what is going to happen to the real estate market. You know it's going to go through the roof. Right now we have the highest interest rates in the history of the past 23 years. And even with that said, you guys need to know that we have plenty of people buying because they are using the negotiating powers. They are using their agents to get the contributions from the sellers, and they know that they're going to take advantage of the price points that we have right now on the market. And later on, whenever the interest rate is going to go down, they're going to take this lower price that they're getting today, and they're going to refinance it whenever the rates go down.
That's correct.
At the same time, most of the people who manage to get the contributions and get their rates bought down closer to 6, most of those people, they don't even think that they will actually take advantage of refinancing. So if you get your rate around 6, you might be keeping it for a very long time or until the next pandemic happens.
Until the next pandemic happens. But what I wanted to add, Alexandra, is quite often people think that they won't qualify, or quite often people think that they'll qualify easily, and it's the opposite. So I was speaking with a gentleman who was like, "You're not going to give me a $200,000 loan." That was yesterday. I'm like, "Okay, how much money do you make?" "This much." "How much debt do you have?" "I don't have any." "Well, I'll give you more." Does that make sense? So, and he was so humble. He's like, "No, I won't qualify for 200,000. I'm like, "Yes, you will. You'll qualify for more." And in other cases, someone will come in, "David, I want a $500,000 house." I'm like, "All I can give you is 200,000. So that happens too. So talk to your neighborhood friendly loan officer.
Yes, do not assume, do not trust those online calculators. Please do not trust any source where they just take your income information and they do not check on your credit score. That is not a reliable source of information. You want to have the answers, you want to have good answers, go ahead and talk to a professional who knows what they're doing. And if you're not sure, if you don't know the professional, Google, see somebody with the good reviews.
Google David Gazette. I'm kidding. Google someone with good reviews.
Right.
Sure. Why not? But Yelp is a great place. Google is a great place. Find those authentic reviews. See what people think. Yeah.
Now, I would disagree about Yelp, to be honest with you. Where Yelp is a paid source. Yelp is a paid source. Yelp is a paid source. So a lot of times, good companies that refuse to pay Yelp will be at the bottom of the search just because they don't pay. But I would say, guys, do not look at do not look at the stars if you're doing the review. Like if you're looking at the reviews, at least read into the reviews and see if the people are saying, because sometimes people say, "Oh, I didn't like the restaurant because
ambiance.
I did the waitress."
The food was delicious, but the ambiance was not 5 stars or whatever. Some
Correct.
Ridiculous.
So read into the reviews, and I know that if somebody Googles IQ rate mortgages, I know that they're seeing the good reviews, so I wouldn't be worried about that. I know that if anybody Googles my name and those are the reviews from our clients. No, we don't put too much pressure on collecting all of the clients' reviews, but those that you see there are from our clients who's been serviced. And as usual, if you have any questions, if you need to schedule a personal consultation, David and I are always available. You can DM us. You can call our offices. You have our email addresses. Just reach out. Our consultations are free, and we will be happy to sit down with you and to talk to you what is on the horizon and to actually talk out your unique situation and see how you can take advantage of this market and what is in this market for you.
Yay.
Thank you, David. Thank you as always for your time, for your input. We really appreciate you and your team. And have a wonderful week. I see you on a live next Wednesday, and I'm going to be giving you a call in a few minutes.
All right.
Off the camera.
Thanks, Alexandra. Thank you so much.
Thank you.
Talk to you soon.
Thank
Bye-bye.
you. Talk to you soon. Bye.